Hi everyone, welcome to week 6. I think you'll find this week is a lot less stringent and difficult than last week. As I said, week 5 is our most difficult week. So week 6, even though we have 3 chapters to read, the problems are a bit more straightforward and easier in general overall. So let's take a look first of all at CP 833, requirement 1. Now, this is a continuing problem, but there's really nothing that you need to refer back to the previous weeks for. And what we're doing here is a bank reconciliation. A bank reconciliation, for those of you, it's very similar to balancing your checkbook. I know that many of us don't do this anymore, but those of you may be familiar with that practice of balancing your checkbook. This is the same basic idea as balancing your checkbook. So what you're going to see in the problem is in the textbook, you're going to see the cash T account that looks at the cash account, and you're going to be seeing the bank statement. And what we're doing in this problem is reconciling what we have in our cash account to that which the bank says we have. Now, why we need to reconcile it is because of a timing difference. So the bank produces a statement as of a certain period of time, but you may have done transactions that have not yet been recorded and actually have hit the bank yet. And the bank has done some things that you haven't necessarily recorded in your books yet. So that's what we're doing. We're reconciling the two to make sure that we come up with the same balance. And so what we're going to see is you're going to see that a bank side here, and you're going to see the book side here. The book side is that which the business has, Davis Consulting, and that's represented by the cash T account. So what you're going to be doing is putting the bank balance in here as of March 31st, 2015. So you're going to put the ending balance of the bank statement. You're then going to add any deposits in transit. Now, a deposit in transit is a deposit that you have made and you have recorded in your books, but it has not yet hit the bank statement. So by the time that bank statement was finished, you made a deposit, but it's too late for it to be recorded in that bank statement. So that's what a deposit in transit means. It means that you've recorded it in your books, but it hasn't hit the bank yet. So you have to add to the balance that they have, the ending balance, you have to add any deposits in transit. Then what you do is you subtract any outstanding checks. Now, outstanding checks are, again, those checks that has been recorded in the books, but has not yet cleared the bank yet. So you may have written out a check to whatever vendor and sent it out. Well, you've deducted it from your books, but it hasn't yet hit the bank yet. So you have to decrease any outstanding checks. Now, if you look at the cash T account, you're going to see, of course, that the left side is your debits and the right side is your credits. So the debit side is anything that increases that bank account, and on the right side is anything that decreases that bank account. So your outstanding checks are going to be on the credit side, and your deposits are going to be on the left side, the debit side. Okay. So after you add you have your ending balance according to the bank. You add your deposits in transit. You subtract your outstanding checks, and then you're going to come up with an adjusted bank balance. So on the book side, what we need to do is record anything that has happened that the bank has recorded, but you haven't recorded in your books. So those would be things like electronic fund transfers, anything that is electronically set up to go every month. Also any interest that the checking account has earned, or any service charges that the bank has incurred. So those are things that the bank has recorded on their statement, but you haven't recorded in your books. So you need to make sure that you record those in your book because they have happened, in your account. So you're going to start with your balance in the books as of March 31st, and then you're going to add any EFTs, any collections from any vendors. So those are electronic fund transfers that have come in. And then you have to subtract any electronic, let me go back. Then you have to add any interest revenue, and you're going to come up with a new balance here. Then you're going to subtract any electronic fund payments that you have set up automatically to be sent out to vendors. So those would be, in essence, kind of similar to checks, but you've set it up electronically through the bank to happen on a monthly basis. So you're going to subtract any electronic fund transfer payments, and then you're going to subtract any service charges or bank charges that the bank has put onto the account. And you'll have an adjusted book balance. Now at the end, your adjusted book balance should be the same as your adjusted bank balance. If they are not, then you've done something wrong. All right, and I can just give you a hint that the ending balances for both of those should be $30,325. So your ending balance on the bank side will be $30,325, and on the book side will be $30,325. So you can see we've reconciled it so that we know that in essence we have the same balance, and that's what a bank reconciliation does. So after you've done that, what you want to do now is all of these transactions that the bank has recorded, all these electronic fund transfers, the interest revenue, your service charges, and your electronic fund transfer payments, they've been recorded by the bank, but you haven't recorded them in the book, so you have to do journal entries in order to record those. So requirement 2 will be those journal entries that you're going to record for everything that the bank has recorded but you have not recorded yet in the books. So this is your way of recording those in the books. And then you're just going to, down here, do your transaction and do an adjusting cash T account. So you're just going to basically put in whatever you have debited and whatever you've credited from these journal entries that you've done. And that's all you do for CP 833. Now, the next problem is from Chapter 9, E919. And in that particular problem, what we're doing is we're looking at the aging of accounts receivable. And what we're going to do here is we're going to be estimating what we expect our write-offs to be, or what we anticipate being uncollectible. And the way we do it in the aging of accounts receivable is that we have a certain amount that we expect to receive in the 1 to 30 day category, the 31 to 60 day category, 61 to 90, and over 90 days. Those are our accounts receivable, what we're expecting to receive as payments from our customers. So the way that we estimate an allowance for uncollectibles is based upon prior history. We know that basically in that 1 to 30 day category, we're not going to collect 0.4%. So we can estimate 0.4% of $80,000 will be uncollectible. So all you're going to do is multiply the $80,000 by 0.4%. Now remember, just as a little math hint here, that when we're multiplying a percentage, we're going to take 80,000 times 0.4%. So we have to move that decimal point 2 places to the left. So you'd be multiplying 80,000 times 0.004 in order to calculate that amount. In the 31 to 60 day category, we expect that 5% of those will not be collectible. Now the reason that this percent uncollectible goes up is because the further along that the account receivable ages, it's less likely that we're going to collect it. More people are going to be defaulting on that and not paying what is expected to be paid. So as the account receivable gets older, the percentage of uncollectible goes up. So we can see that by the time it gets to 90 days, we anticipate, based upon prior history, that 50% of those accounts receivable we're never going to get. Okay, so you just multiply the accounts receivable for each of those categories by the percentage that we're expecting to be uncollectible. And after you've done all 4 of those, you're then going to come up with a total estimated uncollectible amount. Now this amount here is going to be what we anticipate to be uncollectible. So this is what we want to have end up. This is our goal, our target goal for the allowance for bad debts. It's the kind of, I think of it as a kind of an account that we set aside that we expect not to be collected from the accounts receivable, and it's called bad debts. It's an allowance that's set up. That allowance account is really what's called a contra asset account. And a contra asset account means that it comes against or subtracts from the asset account, which is accounts receivable. So since the normal balance for accounts receivable is a debit balance, our normal balance for the allowance is going to be a credit balance. Now, what you need to make note of, because you're going to do your journal entry here for our bad debt expense. And so our debit's going to be the bad debt expense, our credit will be the allowance. Now, what you want to keep in mind is that they tell us that there is already a balance in that allowance for bad debts, and it's a debit balance of $1,600. Now, that's very important. Keep that in mind. It's a debit balance. Remember, I said the normal balance is a credit balance. So here we estimate what we expect that uncollectible amount to be. That's what we want. That is our goal of where we want the uncollectible, the allowance for bad debts to be. So if we have, and that would be a credit balance. So if we already have a debit balance of $1,600, the journal entry here will be the amount that will be needed in order to bring up that allowance account to the 10,000. I'm sorry, I didn't mean to try to give you the amount there, but to the amount that we expect that allowance to be. So if we have a debit balance in that allowance account, we need to bring it up to what it would be, what we expect the allowance to be based upon the aging of accounts receivable. So just keep that in mind. It has a debit balance currently, but we're going to have a credit balance based upon that estimated total uncollectible. And then in the next requirement 2, we're simply going to do the T account that based upon that journal entry. And then here we're going to do kind of a mini portion of the balance sheet where we're going to have our accounts receivable, and we're going to subtract out the allowance for bad debts and have a new balance in our accounts receivable. So remember that what we're doing here is we're estimating the amount of the allowance that we expect to be uncollectible, bad debts. Okay, the next problem, CP 9-41. This is another way of estimating what we expect our bad debts to be. And in this particular case, what we're doing is using the allowance method. The allowance method is basically saying that we're estimating uncollectibles to be a certain percentage of our credit sales. So it's very simple. All we have to do is do a calculation based upon what they give us in the problem as being our credit sales, and then the percent that's expected to be uncollectible of those credit sales. So it's just simply a matter of multiplying the percent times the credit sales. And then it says that our second journal entry here is just going to be that we're going to find that one of those, now remember, we're estimating what the uncollectible or what the allowance for bad debts is going to be. But then when something becomes uncollectible, we then have to create a journal entry. When we determine that a specific account is not able to be collected, we then take it out of that allowance account, and we actually then subtract accounts receivable as well. So when we discover that a particular account has not been collected, it's no longer estimated, so we can take it out of that allowance, and then we have to actually subtract it from accounts receivable. Then the final problem is a depreciation problem. And this is fairly straightforward. We're going to be doing 2 different methods, the straight line depreciation and the double declining balance depreciation. So we're being given the fact that we have purchased 2 particular items, a computer and an office furniture, on December 3rd and 4th of 2014. They're expected to last 5 years, that's their useful life, and both assets have a residual value of $0, meaning that at the end of that useful life, we don't expect that there would be any residual value left. So we just basically do a straight line, and there's the formula of what you use for straight line, and here is the formula of what you use for double declining balance. So you just simply plug the numbers into both of those and come up with your depreciation expense, and then in the last requirement you do the journal entries for both. Okay, I hope this clarified some things for you, and if you have any questions, feel free to contact me during my office hours at 602-639-7378, or you can contact me through the individual form. Good luck this week.